Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
Welcome back to Avenue Podcast and Update. We were actually going to do this normally after our quarterly report came out, but it's actually become very relevant today. Just we have a real market downdraft that we've been in, and I think we just wanted to take time and talk about it. And I think mostly from our own perspective, we've gotten a couple calls and emails so far. I think one of the comments you made is that so far this has happened so fast that if you're not following financial markets on a day-to-day basis, you might not have even known it happened yet. And so we certainly want to get a message out there and opening comment of saying, we feel like we're doing relatively well. But I'll throw it to Bryden. You had a great sort of, one-liner this morning of sort of getting, putting your head around, what is actually happening out there.
Yeah, I think the analogy that we like to think about is really, you're a plane in the air that starts to go through turbulence. And when you're in that sort of period, a pilot has no choice but to keep flying the plane. And so, I would say we're dealing with one of these experiences right now in the markets. And I think, as our core part of our strategy is really being able to help people get through these kind of periods. But there's no, wishing that you were on the ground. You're now in the air. And I think, as we're evolving here with what the market's doing, I think that's sort of the way we're thinking about it, at least in terms of, risk management and both being opportunistic, but also managing risk. And I think for me, that was a great analogy just to highlight, because it really speaks to where we are, and you just have to get through it essentially as long-term investors.
Yeah, so maybe I'll frame it briefly. So at the end of quarter end, and I'll touch the main themes of the quarterly letter, we were actually flat on the year. So an awful lot, and now we're down about 9.5% year to date of today. Maybe I'll frame that. NASDAQ, so the big technology stocks in the US are down about 30% since November. And the S&P 500, which has a lot of the big weightings, we said the extraordinary thing of our time is concentration. And we said, index investing is great, but it actually is about the last 3-4 years has gotten very risky because the concentration risk. 4 or 5 stocks make up a huge chunk of the index. And so now we're seeing that sort of unravel real time with the S&P down about 20. And so we sort of always highlighted we were defensive starting in the fall, absolutely making sure these are real businesses. These are essential businesses, making sure our valuations are all right, and then having the position defensively so we can take advantage of any weak market. And so as the market coming off, we've actually had one of these conversations like a few years ago, like as the market comes off and we're defensively positioned, we're actually sharpening our pencil saying, well, how are we going to take advantage of this? Not saying exactly to your analogy of the plane in turbulence. We're not sitting here just trying to ground the plane. We're not land it, let's wait for the storm to go over. In the turbulence is where we can take advantage of it as long as we're defensively positioned. Yeah, no, very well said. I think before we jump into that aspect of it and just sort of talking about some of the opportunities that we're seeing, maybe take it back to really highlighting, what has gone on maybe even in the last 5 months, and especially in terms of interest rates. Interest rates have backed up and risen, and that has been, largely part of the reason why we've had this revaluation of the stock market. And so maybe do you want to touch on that aspect of, the impact that rise in interest rates is having, especially on the technology sector? Yeah, certainly when we go back, 20 years, and the big event inside that 20 years was the financial meltdown. And it was a meltdown of confidence in the financial institutions. And the result of that was lowering interest rates to the point of just get everything liquid and everybody dealing with each other again to save the system. And I believe we would all argue at Avenue is that interest rates stayed a little bit too low for too long, and you've got all sorts of distortions. And we started giving, in reports and in our annual update, we were just sort of saying, if this keeps going, you will start getting real distortions that we've seen in the housing market, which everybody can identify with. But really where you've seen it is in growth stock investing. Companies that hopefully are going to make money in the future got really expensive. And I love this acronym. We always said, as Avenue, even when we're writing and we're talking, we're going to be jargon free. But there was a great sort of argument on COP stocks, which I love, which is crazy overpriced stocks. But it just even became an acronym in itself. And when you have, so in Canada was Shopify, we had the whole cannabis. You just sort of go, these are all real businesses. They're all great Canadian enterprises, but they got way too expensive. And I'd say the big theme we want to touch on today is that interest rates have gone up a lot from almost nothing. I'll touch base on that. So the stock market historically uses the 10-year bond yield to sort of give where pricing is. So if you're going to build something, I have to borrow the money. It takes a while to build it and then get paid back my loan. Mm-hmm. So the bond market now yields about 3%. And if inflation is running where it is, maybe it goes to 4%. But even if that is, you're 3/4 of the way through the move, or we actually might start seeing a slowdown. We'll touch on that. 3% might be the level, in which case interest rates are most of the way through the move where they're going to back up to. And then those crazy overpriced stocks have already collapsed. Mm-hmm. And we're sitting here today trying to pick through things. And I'll throw it back to you. We've actually been dipping our toe in and we bought a few things recently.
Yeah, I think the other thing too is, and we were a little bit ahead of this in sort of how we started articulating our views last fall, saying that, coming into this year, there was the expectation that growth was going to slow. We didn't know the magnitude of which it was going to slow. And I think what changed certainly was December, January, when the central banks came out and said, no, we're really going to step our foot on inflation here. And then, with the stuff going on in Europe and Ukraine and the impact that that's had on prolonging the inflation, I think that has even accelerated this sort of monetary tightening from central banks, which then has, pushed the market lower and lower and lower. At the same time, there's a lot of things. I think, I was saying to you, in my 10 years, I have not seen this many great businesses start to come back to reasonable levels. It doesn't mean, today or this week you want to go all in and spend all of our cash or spend all of our defensive positioning, but there's more things for sale today than I've seen, in a long time. And so that's part of our work too, of making sure that we're looking for opportunities where we can find them. Staying defensive is sort of our core idea, because, our expectation is that growth is going to slow this year. It already is. And if you have a central bank that keeps pushing on a tightening policy into a slowdown, a recession later this year is, I think, certainly, a reasonable expectation.
Why don't we, I'll stop you there, but make sure we cover this point in detail, because we would argue that this is the one thing that has really changed, which is, recent quarterly letter saying one of the most dangerous things you can say in financial markets is it's different this time. And what is different this time? But I would say that going back last fall, I reread one of our quarterly letters where it was, we were making a bold statement of saying that inflation for the last 5 years have been running at 1.5%, and we thought it was going to double and it was going to aggressive. So you better get ready for inflation. Last year, by this time where we are right now, we might boldly say that inflation might be running at 3%. And so we built the portfolio around inflation, but I'll throw it back to you. We have real inflation now, but just characterize, as you say, the central bank thinking and how that relates to the expectation for the economy, inflation rate for the next year, and then unemployment.
Yeah, I think the problem that central banks are now facing is they, in many ways, sort of have egg on their face, because all of last year, their expectation was inflation was not going to accelerate like it has. And I think there was the idea last year, the economy was going to reopen after the pandemic. You were going to have some kind of normalization. But, even looking at what's going on still in China, looking what's going on in the energy market, all of these other exogenous impacts are now being felt on inflation. And I think the hard part is that there's certain components of inflation that are getting very sticky. So, shelter inflation is high. Food inflation, I think everybody's feeling. Energy inflation is much more volatile, but like for shelter and food, those are very sticky parts of inflation. I think what's scaring central banks is how embedded they can see inflation expectations are becoming. And that is sort of their no-no, essentially, for how they guide policy. And so, they have no choice through the lens at which they view their job, but to stomp on inflation here. And I think what's interesting, you haven't seen this from central banks going back, even before the 80s, but you now have central banks that seem like they are willing to allow for an economic slowdown and even unemployment losses at risk of inflation becoming unanchored, essentially. And so whether they should be doing that or they shouldn't be doing that, as investors, we have to focus on, what is most likely to happen and not say what should or shouldn't happen. I think that's kind of the way we view things. But at this point, they seem to feel like they have no choice but to keep pushing on inflation, which is going to mean more rate hikes and tighter monetary policy, which means even into an economic slowdown, they don't necessarily seem like they're going to be easing up anytime. So, I mean, that could change in a week, it could change in a month. So I think as investors, it's important not to get too pessimistic. And the other thing that we wanted to really highlight is just how historically negative investor sentiment is. If you go back 30 years and you're at record levels of negative sentiment. And so generally when everybody thinks something's going to happen or when everybody's already negative, what that is telling you is that there's a lot of negativity already priced in to lower stock prices. And so does that mean that there has to be a reversal, this week or next month? No, but it at least lets you take a temperature for the market, and everybody is negative essentially. And so the question will be, how much worse does it get from here in terms of the economy? And that's, yet to be determined. But I think that from our perspective and how we're balancing the portfolio, we think the chances of a slowdown from here are still very high. And so being defensive and being disciplined, I think, is the right thing to do. But to your point, we have been picking things away, and we have, our idea list that we're sort of sitting on. But I think that caution is still the word of the day. And that's kind of how I would sort of incorporate that central bank impact on, where the market is right now.
Yeah. So in sort of a summary, where historically, if you had financial turbulence, central bank will cut interest rates. If we don't expect that to happen, historically, if that had happened, your stock market can come rocketing out. And we would say that sentiment is extremely low. Force yourself to get positive. Let's look at these high quality businesses. We don't think we're going to come firing out of it, but these might be great levels to pick up great companies that will just churn along, and we can get our expected level of compounding out of a pretty unexciting market.
Yeah.
And going forward. And there's going to be an awful lot of noise from inflation and from the economy, and we can still execute our investment plan even in the middle of all that noise.
Yeah, and that goes, to tie it back into the analogy of flying a plane through a storm, is essentially there are many things that you're doing as a pilot on that plane through the storm. It's not flying itself. You're executing your plan, in that scenario. And I think in terms of managing the portfolio in a period like this, it's very similar. It's just, we have our strategy, we have our things that we're looking at, we have our positioning that we're constantly evaluating. But once you're in the storm, it's how do you protect against a market like this, but at the same time, take advantage of opportunities where there is a lot of pain out there. And there are, more opportunities that we've seen, in many, many years, because this has now been, we're into month 5 of this essentially, which is sort of from a time perspective, the longest pullback we've had, coming out of 2009 essentially. And so there is a lot of pain out there. There's a lot of opportunities though. And so we're trying to balance that posture of being defensive, but at the same time, starting to get excited about certain investment opportunities.
So maybe for myself, I'll leave it on the last note, just making sure we touch on the bond market. I believe our next podcast, we'll have Paul Gardner come on and talk about positioning of the bond portfolio. And in very simplistic terms, that interest rates are higher. Short term, the price of bonds go down as interest rates go up, but that's why we're positioned shorter term duration. We've had cash. We're now looking at this rate to just, again, take baby steps into the market. And as the bonds mature, we're able to reinvest at the higher interest rate. So interest rates going up as a long-term bond investor has to be better. By definition, we are getting a higher interest rate over time. We'll be able to compound at a higher level. There's just a short, period of time it's painful as we readjust the portfolio. But when interest rates were under 1%, it was getting very, very difficult to manage a bond portfolio. So just like to pass on that this absolutely has to be better, that interest rates are higher.
Yeah, no, I completely agree with that. And so why don't we wrap this up on that, and then we'll look forward to our next conversation more specifically on the bond market.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog, or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.